Hello friends, welcome back. In this quick demonstration, we are discussing 1 hour chart again, and we are tracking our critical indicators here. On the bottom, we have what we call as the contract tracker, and on the top, we have what we call as balance imbalance indicator. And what we have done on the bottom contract tracker, added Bollinger Bands on top of it to see the volatility depth of the contract tracking. Our interest lies when these sites get into a most contractive state, which is right here on the bottom. If you look at it closely, the bottom channel is where we have marked, let me mark it here, where we have the loss of interest for the sellers, and we want to track those things to create our bias for a given days. On the top, we have two moving averages, nothing else coming out of it, just to give us a visual synthetic representation of bias. Remember, they're just moving average for reasons. So our interest is pretty simple. We want to go long and have a long bias. We're going to let this settle down at the bottom. Now this is hourly chart, and it is not used for trading anything else beyond that, just to give us a bias. Now if you want to trade contracts on options, we can have to adjust it a little bit differently. So if you look at it, what we are saying is when we get at the bottom edges where we have two lines, there is no interest actually in the selling anymore. So let's mark those zones here. This is the zone where we have lost interest in selling. You can see here. And here, let's mark it here as well. Now remember, we're not going to take things blindly, but we are looking at the zones where we are losing the, first of all, the interest in selling. And then we can do the same thing on the other side. So it is giving us actually a simple model where we are trying to express where are the buyers and sellers positions at this point. We have it here as well. Now this is hourly chart, which means small moves like these may not be of too much interest to us, but we don't have any context of the price targets. We also don't have the context of market maker reversal models. So we're going to add that right now. So we have brought our C54 tool from level 1 advanced modeling, and I put this here, and we are already projecting that we are going to go and extract the trend change at this location. And where we see here is, you can see it now, it is going low here as well, it is low here as well, it is low here as well. Now we have a context that we are expecting the market maker to show up and be a bullish defense for us at this point. Now it makes sense. And also at this point, we also have the balance imbalance, which is, think about your profiling architecture, where we have the bell curve and we have extensions from the mean and from the POCs. So this is what is going on here as well. So now we have a confluence of events happening at this point, this location, and now it makes sense that the sellers are gone. But this is hourly basis, so you can maybe you can just take a simple algos just to swing down at one more last leg. So this is where we see the buyers are showing up, and we can see the buyers bar showed up here as well. And now we can take this all the way on the other side. So let me adjust this tool again, not to waste our time, and then we can see where the tops are coming, bottoms are coming, and this is how we swing at a different frequency on the hourly basis. All right, so I have flipped the tool on the other side, and let's do this properly. So now what we have is, this is a trend line. We can take this trend line. There are 3 trend lines. Watch the videos. There are 3 trend lines. This trend line is going to go all the way to the top, where market is going to hit one day and it's going to come there. It is coming. It's not too far and it's going to come. Okay, that's what, watch this video is on videos. Now this is very high profile of the market move. We are going to make a little bit steeper trend line as well. So we adjust this, take it to the break line, and this is another line we can draw right there. Okay, so that is also going way on the top. All right, so remember, there are 3 trend lines and they have 3 slopes. We have been discussing that 3 slope phenomena for a long time. So this is one trend line, and this is a good one because it breaks and retests it. And then we have extremely high sloping trend line, which is, this is the extreme of it. So this is the minimum. We cannot do anything more than this. And then the second one is here, and then the third one is going to be very sloppier. We have to find that trend line. I see 2 of them. The third one could be, remember, if we go to slow, support becomes resistance, and then we can do this one, which we already did, and then other one can be this one. So 3 trend lines, very harsh slope, medium, which I showed you where it's going to go, and then we have the third one, which is going to be another one. So the best way to see which trend lines are going to work for you, because once they break on the other side, they come to retest it. This is another one. They are all going to give us some long targets. So from the very high steep, we are able to get to this level, as you can see here. So we got that block, and now we're getting this block. Now at this point, once we reach there, this is what we have been doing for almost 18-20 months here, which we are predicting everything based on this phenomena of market makers and other 7-8 models. But on a daily basis and on a intraday basis, hourly is very important, 4 hours is very important. So hourly binds 4 hours to the intraday charts, 4 hour binds intraday charts to a daily chart, and what we are looking for is on the hourly to bind the bigger swings where the big players are going to come and defend, and they are going to make a trend for a couple of days. So at this point, when we are reaching that state, what are we looking for? We're looking for it to reach the upper locations, which is, so this is the bottom location we have seen here. There's also upper location of contract tracking, which is on this side on the top. So once we reach that higher zones, we are expecting the sellers are most likely gone right here. Sorry, the buyers are most likely gone, which is one here, another one is here, another one is here, another one is here, right? And it doesn't tell you how far they will pull it down. That comes from the C54 model and nothing else. And once we reach the C54 model, now I have a lot more interest. You can also observe very acutely that something else is also transpiring here, and that is the divergence. Look at the value and the price, but look at the number of contracts. So less number of contracts were traded on the hourly basis to make this move into the market maker zone, and we have an obvious potential trend change. So I hope understand what's going on. So if I do it from here, I think we will get the same phenomena here as well. So let's assume that our levels are sitting here, or that is hitting here from the previous level. Earlier it was at the bottom, now it is on the top, and you can see what we see here is simply, you can see that these two conditions are met again at our level. Now you can see the price went lower, but the value was building up. So there's a reverse divergence here going on, and which can also be used for our advantage. So this is giving us a beautiful bias. Let's talk about today. Same thing. You can see there's a lot of sellers trying to push the market, but the buyers are the hidden agenda in the market. There's a divergence going on, and you can see market was trying to follow a little bit drift or sideways, but the value was being built up. And what is going on? It is happening at the sellers have left the building area. So same thing happened here. We had low interest. We have higher, and then you can also use these as overbought, oversold as well, overbought, oversold as well, overbought, oversold as well, right? So putting these two things together makes a huge difference. So one thing to notice is this is the reason why we cannot blindly take buyers are gone or sellers are gone, because they can drift much longer, and without the context of location, it will be hard to qualify this, because the location is there first, then it makes sense. Here is again the same thing. Market went high at the short location, but look at this divergence on the contracts. These are very powerful ones, but they can, now this is where any indicator you have has a challenge, which is it a pressure or is it overbought, oversold? How do you know the difference between a pressure state versus overbought, oversold state? You have to think about it, what I'm saying. How do you know this is going to be an overbought state, or it is a pressure state, that it is continuing to go a little bit longer than expected? If you take any oscillators, they can be overbought, oversold for a very long time. How do you know the pressure is going to be over? Remember, it is the hidden dynamics of the market makers and the banks and quant engineering which is driving. We have a lot of complex secret formulas which comes through a lot of innovations, and you have seen this almost for 2 years now, and we can see this. Not having the right location is where all things fail. Now the reason I am mentioning that at this point is when we know that market is going to go from here to here, the context of overbought, oversold has to be flipped on the pullback phenomena. You have to switch the context into the pullback idea. So this is where this oscillator we have of value balance imbalance is coming into picture. So if I am going to go and not do anything short until this track has been addressed, I'm just going to look for pullbacks. So let me clean this up. So I'm saying that I'm going from here to here, which we know, and we know from here to here. We also know that. We also know from here to here. We also know, once we know all these levels are coming, my job is to treat these oscillators as pullback in the direction until the sentiment has been reached in terms of the target. So what we do, once we know that, we are just going to use these as pullbacks until that happens, and pullbacks until that happens, and pullbacks and pullbacks. Now you see, I think I'm not drawing it properly, but you got the idea. So all these are now giving us the context that, hey, whatever we're trying to do, we're going to continue to do that, which is trade the long direction only, and this is now acting as a pullback. Now if we are going from here to here, now I'm buying the dips, buying the dips, buying the dips at the bottom, buying the dips at the bottom. Now I'm going to reverse and flip on the other side, where I'm saying, okay, I'm going from here to here. I'm going to just sell the rallies, sell the rallies, and sell the rallies. So I'm going to be taking the upper side of the equation until I reach my destination. So where's my sell the rallies? Right here. Where's my sell the rallies? Right here. Sell the rallies right here. Sell the rallies right here. Sell the rallies right here. So now you see that by virtue of knowing which swing is in control, which direction I am going, I have refined my entire analysis. So same thing happens here. That's why moving averages and all the oscillators you have don't work, because there's no structure, there's no idea of how the banks are rotating the market, how the market makers are rotating the markets. Now I'm saying market should be going from here to here, and if I tell you that, what is your primal duty? Simple. Buy the pullbacks. So this is the one good pullback which came here from this. This is another pullback which came very sharply, right? And then we are at that target. This is a high risk pullback because we are at the reversal zone, right? So I hope that makes sense. And if we are going to go short now, right, from this area, so my job is to take shorts only. This is a short, and this is a short. Now everything starts working very nicely, at least in terms of the bias, because we are taking the bias effectively. So once we are here, I'm going to give shorts only. So here's the short, I'll just mark it. Here's a short, right? Here's a short. And they're all working now. Why? Because of this equation. Now this is happening on an hourly chart. Now we have to do this on other time frames too, multi-time frames. Eventually the daily will trump everything else. So you should always keep a daily SPX chart or SPY chart, a 2-day or 3-day chart. Gann always talked about having a 3-day charts. So you should have a 3-day chart, and you see everything start looking very smoothly, and then all the indicators will also work. Now from the 3-day we move to 1 day, we move to 4 hours, we move to 1 hour, we move down to 15 minutes, 30 minutes, 15 minutes. And this is where we now have our context of precision trading. But the bias is already established, right? So which direction you want to go. So that is what is going on. I hope this helps, and we'll go from there. Thank you very much.